good segue from that panel we just heard into this. I think that gave us a good foundation for this. So thank you all for attending our panel, COVID-19 Municipal Bond Market Response and Outlook. This session, we're going to be looking at the state of the municipal bond markets during the early days of the pandemic, the effects of various policy responses on the market, and the outlook for the market moving forward. And our aim in this panel is to inform market participants on what's in store for them moving forward and inform future policy responses by both issuers and regulators. I'm Rich Reifel, a professor of finance practice at Washington University in St. Louis, and one of the co-chairs and co-founders of this, our ninth conference here at Brookings. I'm joined by an impressive panel of experts today, so thank you, panelists, for joining us. Their full bios are posted on the conference website, but briefly they are, and maybe you all can give a wave to the camera, Sarah Snyder. Sarah has 15 years of public finance banking experience and is currently a managing director at Ramirez. She focuses her practice on origination, structuring, and execution of municipal debt across various sectors, including water and sewer, airports, transportation, and general infrastructure. And Sarah also is a proud graduate of the Olin School of Business at Washington University, one of the presenters of this conference. Our second panelist is Patrick Brett. Patrick is a managing director and head of Citi's Municipal Debt Capital Markets and a member of the board of directors of the MSRB. Patrick has been with Citi for 20 years and has experience both in the US and globally, which will come up in our conversation today. Gary Hall. Gary Hall is a partner and the head of infrastructure and public finance at Siebert Williams Shank and a partner at American III Partners, an infrastructure private equity fund. He's the immediate past chair of the MSRB. And last but not least, Kent Highyield. Kent is a longtime public finance banker with a lot of experience in the markets working and advising issuers. And recently he was hired by the Federal Reserve Board to help it analyze and craft its response to the municipal market dislocations that occurred in March. So again, thank you, panelists. A couple of brief housekeeping notes. You've heard from the other moderators that viewers can submit questions for us by emailing events@brookings.edu or by joining the conversation on Twitter using #MuniFinance. And a quick reminder that at the end of this panel, there'll be a short break, and then we'll reconvene at 3:45 Eastern Time with two concurrent breakout sessions not hosted on this page, this link that you're on now, but rather by Zoom webinar. So we'll hope you'll join one of those two breakouts. And you should have an email if you registered from Brookings with the details on all of that, or you can email Stephanie Sensula at brookings.edu at ssensula@brookings.edu if you have any trouble. So let's get started. And I've, in prepping our panel, I've asked each panelist to be prepared to answer each question. So a reminder, the panelists to be brief, and I'll remind you the order that we're going to ask you to answer these questions because we tried to mix it up a bit. So the first question that I want you all to address, please, is just give the audience a sense for the condition of the muni market in March. What was happening as this shutdown was happening in the kind of early days of the pandemic in terms of flows and liquidity and price discovery? And we'll start with Sarah, please. Sarah, you're muted.
I'm unmuted now. Apologies. Okay, so you can hear me? We're good? Okay, so it's amazing to think that this was 4 months ago, and while many of us experienced this firsthand and probably don't necessarily want to relive it again, I'll just give a few points of what happened in kind of the first 2 weeks of March, just to set the stage, and then kind of pass it on to others to give more detail. But looking back, it's really unreal that this all occurred within a 2-week period. So going into 2020, fundamentals were strong for munis, both in the market and from a credit perspective. Issuers had, almost stopped talking about what happens if we go into a recession, but the vast majority were more prepared than they were in 2008, stronger reserves, but nobody really could have predicted the quick turnaround that was ahead of us. So, at the end of February, MMD had hit all-time lows when we didn't think that that was possible again. The stock market saw large swings as, COVID was at fever pitch and causing investor participation to wary and, the storm to start brewing. So, the week ended March 6th represented the inflection point for our market. We had extreme volatility with 2,000 point swings in the Dow. On March 3rd, the Fed Reserve delivered an emergency 50 basis point cut to the Fed funds rate. There was a flight to quality where treasuries came down significantly. The 10-year treasury lowered by about 70 basis points over a 2-week period. And we ended up with ratios that were over 200% for munis versus treasuries, which we hadn't seen since 2008. And then I think, most importantly for our market was that after 60 consecutive weeks of inflows, there was a panic from investors. Mutual funds began what we would see as 6 weeks of outflows, causing a lack of buyers as accounts were trying to raise cash. So we then, going into the second week of this, that all happened in within a 1-week span. Going into the second week, the oil price war began. And by Wednesday, March 11th, the municipal market decoupled from the U.S. Treasury market. The secondary market was in a free-for-all, and the primary market came to a halt. So nearly all deals were pulled. So as a banker, it was pretty much, full standstill and just providing as much information to our clients as possible. Within that week, 10-year MMD increased by 83 basis points within 1 week. And so, and forget the fact that we had all, as market participants, been used to working side by side. And in this, panic mode, we all then had to go into quarantine. So I'll stop there and let others kind of weigh in, but that kind of, I think, sets the stage for where March began.
Right. Thanks, Sarah. Patrick, you're up.
Sure. Thanks, Rich. And thanks, Sarah, for setting the stage. That was really comprehensive. I mean, just to add my own thoughts. I mean, I have been doing this for about 20 years, and I would say I think what was different about March as compared to the financial crisis, I think, was both the speed of the move as well as the violence of it. I mean, the amplitude of the move Sarah mentioned. I mean, it came on so quickly. Sarah mentioned the Fed acting at the beginning of March, and then kind of almost only a week or two later, we were seeing moves in municipals that we really hadn't seen relative to Treasury since the Great Depression. If you think of the financial crisis, actually came on a lot more slowly. It was March of 08 that Bear Stearns had issues, and then Lehman Brothers was in September of 08, and it wasn't until March of 09 that the equity market really bottomed out. So that one really was a slower burn. I think what was positive, and I'm sure we'll talk about this more, the policy response was also much quicker this time around. Not quite as quick in municipals as some of the other assets, but also unprecedented as compared to what happened in the financial crisis. I think in terms of the moves, I was on the sales and trading side for the financial crisis. And we didn't have the same sort of forced delevering that we had of hedge funds back in the financial crisis, but this was, as Sarah said, it was massive redemptions from the mutual funds that were just overwhelming any natural demand in the market. So we went from kind of negative 20 spread to treasuries for long municipals to positive 200 spread. You could buy treasury-backed municipals. I studied finance 20 or 25 years ago. You're not supposed to have these sort of pure arbitrages, but you could buy treasury-backed municipals that in 3 years at a 3% at a time when 3-year treasuries were close to zero. So there were definitely, the municipal market was going haywire in March, to sum it up in a word.
Thank you for that, Gary.
Well, I had more hair then, that's for sure. And now I know Kent was a little concerned. This is water, Kent. It wasn't then in March. It was really crazy. Conversely, we saw a record issues in the corporate market, over 207 billion, close to 207 billion in corporate, which is a record month for them. I would say two anecdotes for me sort of stood out. Is that first I saw a sizable number of issuers who historically go competitive decided to go negotiating. I mean, and it ran the range, even from the State Public Works Board in California to small school districts in Portland. to the Virginia Public Building Authority, all decided to access the market via negotiated mode, vis-a-vis competitive. They wanted to be able to time the market. They wanted to be able to have flexibility on structures to meet investor demand. And overall, I can't empirically show what the quantitative difference was, but from a satisfactory, just anecdotal standpoint, it seems like issuers were happy that they made that decision. I have one case study for myself that stood out, is that I had my first deal ever in my career that was didn't get completed after starting. We started a deal, was an A-rated credit for issue from a specialty state, which typically draws peak demand, we've seen it with the market technicals we had in years past. It wasn't an essential service credit, which stood out for investors, but essentially we could only get 40% of the deal subscribed. And even that 40% that was subscribed was thinly subscribed, meaning if we had tried to underwrite the remaining 60%, those investors would have left because they wanted company. And so ultimately the issuer decided to pull the deal, and the deal is still on the shelf today. So I think that speaks volume as to sort of the turbulence that we incurred in that time.
Thank you. And Kent?
Yeah, I endorse Sarah's comments about 4 months seems a long time ago. I thought I'd share my day on March 20th with the audience. Unlike the three experts that you've got on the panel, I was out of the muni market, sitting at home, enjoying myself, not worrying about my clients' problems like Gary was. And I got a phone call from an official at the Fed that I didn't know, I knew of, and she had gotten my name from a common friend, and she said, "What's going on in the muni market?" And I thought I'd share with you what I told her on that day. So this is Friday the 20th, and what I said was, clearly mutual funds are going through an unprecedented massive selling of securities to meet the redemptions of their clients. But as prices of fixed rate bonds were plummeting, they were turning to their VRDB portfolios, which they have the contractual right to put back to broker dealers at par. So rather than selling at a loss, they can sell at par. In turn, broker dealer balance sheets had ballooned to reportedly as much as 25 billion of VRDBs, which forced resets sharply higher. So we were at a period on Friday where daily resets were approaching double digits at the same time that treasury yields were appropriately falling towards Fed monetary policy of zero. So this had two immediate effects. First of all, issuers who had to pay these higher rates that was compounding their fiscal stress that they were beginning to feel the effects of. And then secondly, broker-dealer balance sheets and the losses from these securities were compounding the conditions in the fixed rate markets. And then the third factor, all around this VRDB product, which is 1/3 the size of what it was back in 2008, as Patrick was referencing. The supply-demand dislocation within that market was causing mutual fund TLB programs to be turned upside down. So the normal positive spread between the underlying fixed rate bonds and the synthetic VRDBs had turned negative. This caused those programs in part to begin to be unwound, or at least the fear that they would. And in that situation, the broker dealer is basically in the position of having to sell those underlying fixed rate bonds at any price, which clearly contributed to further downward pressure on fixed rate bonds. So I thought that the VRDB market in particular was very, very problematic at the end of that week, March 20th. And that's the message I communicated.
Great, thanks for that. Ordinarily, I think of when you have this much experience together talking about something, ordinarily I would expect you would say, well, I remember the last time something like this happened, and here's the way it was, and here's how we recovered, and all of that. And what I'm hearing is all the last times together did not approximate this time. And so that leads me to this next question of whether this recovery and the sort of refunctioning and reordering in the municipal market is like anything that you've seen in the past, and maybe how it's different. And that gets me to this question. So it's a lot's changed since March, and the market is normalized quite a bit. But could you each give us a perspective for what's changed in terms of investor base, liquidity, issuance, et cetera? And specifically, and we do have a question from the audience about this, if we could talk about the role of the MLF in that. And Kent, you're actually leading us off, so it's an appropriate segue. If you could talk about where we are in the market and what you're seeing there. And again, from the perspective perhaps of the Fed and the MLF.
Yeah, well, given the time constraint, I'll leave the other three to talk about where we are now, and maybe pick up the story where I just left off, and not turn immediately to the MLF, but to turn to something that's probably more technical and not as well appreciated in outside the muni market, is the money market liquidity facility, which had already been rolled out the week of the 16th, but did not include VRDBs because it was limited to maturities of 12 months. Well, we all know that VRDBs act like short-term securities. They have a nominal long-term maturity that is backed by a liquidity facility of a bank or self-liquidity. So the Fed over the weekend concluded that they needed to address this VRDB program problem that I described by simply opening up the MMLF on Monday morning, the 23rd, to VRDBs. So they made a very simple change and just said that they defined the 12-month maturity to include VRDBs that had a put of less than 12 months. That had an amazingly immediate impact on the marketplace. And what I think is very interesting is that we never got very much take up into the MMLF of municipal securities. It's certainly less than $1 billion. I think it may be 500 million at this point, but it's trivial in the overall $160 billion VRDB market. But the mere existence of the facility had a calming effect on the marketplace. Money market funds knew they could sell those securities. Broker dealers knew they had an outlet for them. And rates began to immediately fall to where today they're about 10 basis points. They had gotten as high as 9 that week before. I joined the Fed several days later. Our mandate was to take a look at a market that the Fed had never, in its over 100 years of history, intervened in. We did not yet have the CARES Act, but we had what we call our Section 13(3) authority to intervene in markets in unusual and exigent circumstances. And that's what we immediately began to focus on. 2.5 weeks later, we did roll out the $500 billion MLF program. It's important to remember it was announced on the same day as, in total, $2.3 trillion of federal facilities between the Treasury and Fed across many markets. So the muni market was only one of those markets. The goal, the objective, the policy objective of the MLF was to first address liquidity in the government sector. The most important thing was to make sure that if the markets weren't functioning properly, that state and local governments knew they had a source to keep their governments running, to keep vital services flowing to their citizens. And so the first objective was to make sure that issuers knew they had a source of capital for that purpose. The corollary to that, but equally important, was the view that by assuring that state and local governments had access to liquidity, that would be supportive of the broader and longer term fixed rate muni market, because the market would know that the debtors, the issuers in the marketplace, had access to such short-term liquidity, and they would continue to function and be able to pay their debts in the interim while the market and the economy overcame the COVID crisis. So those were the two policy objectives. People ask about why weren't there longer maturities, why weren't certain entities eligible, we were taking our first step into the muni market with 40,000 issuers and maturities. 80% of the market is a long only market of 10 years or longer. We felt this is the best way to have an immediate impact to get something up and operating. People were also frustrated that it took us as long as it did to actually make it operational. I can tell you I learned a lot in those 6 weeks, and I thought we did something extraordinarily fast given what the issues were. Almost all the other facilities that the Fed rolled out sooner had actually been tried and tested back in the financial crisis. So it was on the shelf. They just had to roll it out. So in any case, I'll turn the story over to the other participants, but in short order, the market rallied to the point where, thank goodness, state and local governments have access to not only liquidity, but they have access to long-term financing. We have major issuers borrowing at less than 50 basis points for liquidity, and certainly less than 2.5% for long-term capital. The market is open, it's different. There's important differences and things we need to talk about. But in terms of the emergency, we believe the Fed contributed not only with these two facilities, but with the broader monetary policy of supporting the quick recovery of the municipal market.
Thanks, Kent. Well, Patrick, your firm is one of the larger underwriters in the market, and you had some pretty significant issuers back in the market with new issuance early. Can you comment on kind of where we stand now in terms of the market and what you're seeing?
Sure. Yeah, and I think a lot has changed in terms of investors, liquidity, and issuance. To take on the three parts of your question, I mean, I think in terms of investors that have changed, and I think Kent covered it, but the biggest investor that's changed is the Fed. I think the signaling effect, as Kent was alluding to, has been really powerful. I mean, I think the Fed really crossed the Rubicon with the MMLF, which Kent mentioned, which didn't get as much attention, but that was the first time the Fed, to my knowledge, really was directly buying municipals. They didn't in the financial crisis. They've had the power since the Federal Reserve Act was created. To my knowledge, it's been dormant. In Section 14, they can buy up to 6 months, but they haven't done so. So I think the MMLF was the first step, and then the CARES Act, actually, just the knowledge that the Fed was going to be armed to be able to come into the market. I think even as the CARES Act was coming together, that's when the market, that weekend of, I guess heading into the week of March 23rd, that was when the market really started to recover, just knowing that the Fed was going to be armed with this power. Of course, I think some people expected the Fed to do a little more, to become a bigger investor, the same way they have in the corporate market, maybe rolling out secondary and primary facilities. They haven't done all that, but I think the signaling effect of the Fed as an investor has been quite powerful through the MLF, and then also through the potential of additional facilities, which Chair Powell mentioned. In terms of other investors, I mean, banks have become a lot more involved in the market, 3 or 4 times as active, I think, by the flows we're seeing in our new issue order books and the secondary relative to pre-COVID. I think that's the relative value between munis and treasuries and swaps. Foreign investors, we've seen a lot more active. That the biggest driver there is probably the currency swap moves. The dollar relative to other currencies has made some of those trades come back in the money. We've seen alternative investors get a lot more involved, and that really accelerated as the municipal market's recovery kind of lagged other markets. Other markets that were the beneficiaries, frankly, of more direct Fed buying and Fed facilities. So I think, and we started to see alternative investors looking for value. In terms of liquidity, I mean, if liquidity got horrendous in March, the bid-ask spreads widened out dramatically. I mean, they've come back, but not all the way back to where they were pre-COVID. Dealer balance sheets have shrunk by at least half, I think, probably the Fed actually keeps those numbers, I think, from 14 billion down to 7 billion. So there's a smaller amount of liquidity on dealer balance sheets at this point, which doesn't necessarily bode well if we have another downdraft. And just in terms of issuance, I mean, for a period of time, you couldn't sell any sort of COVID sensitive sector, and kind of one by one, everything that seemed only a few months ago like we wouldn't be able to sell this year, we've been able to sell, even like sensitive transportation sectors and things like that. About the only sectors that I don't think we have seen, the other panelists can correct me if I'm wrong, but I think hotels and convention centers, credit analysts are still kind of trying to work through what this means for those. So we haven't seen those come fully back. I would also say, even for the ones that have come back, investors are really digging into credits. There's been a renaissance of credit, like deep credit analysis on some of these entities, the same way we saw right after the financial crisis, where the uptake on one-on-one calls and the demand from investors for the very latest information about traffic and revenues and things like that is quite high at the moment, as investors are trying to discern what this all means.
Great, thank you. And Gary, what are you seeing in your corner of the market?
The only thing I would add to what Patrick mentioned is SMAs are back. When we had a precipitous ride in the first 5 years of MMD going up 53 basis points early in March, you didn't see much SMA. Most of them trying to get their money out of funds so they can have cash in order to weather the storm. Bond ETFs are back, and they're playing well, and even insurance companies. The other thing that we started to see a little bit more receptivity to shorter calls. It was reflexively, you had a 10-year par call, and that was sort of the nature of the beast. But investors are starting to be a little bit more receptive to it. Credit enhancement, bond insurance is back. Not in the same sort of palpable way we saw pre-economic downturn in 2008, but more issuers are willingly contemplated after feeling burned after the last go round, and more investors are asking for that comfort. So those are probably the only thing I would add. And then we should note that volume is up. Year to year, we're about 91 billion. And that's 14% over where we were year over year last year. So there is a tremendous amount of stability back in the municipal market.
Thank you. And Sarah, to you, anything the others missed?
I would just reiterate to our issuer clients that it really is kind of the perfect market for municipals to come to market right now. I mean, where we're seeing interest rates again near historical lows, and with demand exceeding supply, we're just seeing strong participation on all credits. There's no longer the haves and have-nots. It's for the most part, most transactions are getting done, and whether the Fed meant to or not, we're seeing munis being very attractive compared to corporates. And so I think that's helping drive down spreads and overall attractivism for our market. So I think it's a great time for it. If issuers are able to come, depending on where their revenues are, it is a good time for them to be in the market.
Great. Thank you for that. So we had a lot of disruption in March. We've recovered, and as to a large degree, the market is functioning. As we heard in the last panel, issuers face a lot of challenges on the revenue side. Some have already adjusted to that. Others are wondering when the next shoe might drop. They certainly have been spending a lot of money responding to various COVID issues. So if I could ask you all to comment on how do you think that's going to play out in the market moving forward? We heard a little bit about potential, deficit funding and things like that, and maybe some transactions that might be able to help on that score. How do you see the market changing over the next year, specifically with respect to things like disclosure? We heard someone reference marketing and digging in, and bond insurance, et cetera. So disclosure and credit issues, volumes, sale methodology, that's a particular favorite of mine to look at, whether we might see more negotiated volume, notwithstanding the comment that was made earlier. And then if you could also make some comments on potential new rules on refundings, which were changed a couple of years ago with the Tax Act, and the role of taxable debt. So I know I threw a lot out at you there, but if I could ask Gary maybe to start on what are you looking for in the next year or so?
I don't know if it was the year I spent as MSRB chair, but I focused a lot on disclosure. And while the first portion of the dislocation we saw during this pandemic was primarily a liquidity crisis, I think the credit differentiation is here to stay. And I think as we saw in the post-2008 downturn, where buy-side credit analysis will sizably uptick, we're going to see that more, even on steroids. Say it differently, you want to see very level of pricing performance with credits of the same rating based on investors' perceived ability to buy and the issuer's ability to sell credit stories. So if you think about major differentiation points, being able to be sure that you have a strong record for meeting your continued disclosure obligations, having the willingness, as Patrick mentioned, to engage investors during the deal process, but I would also add even not in the deal process to get real-time information when necessary. Having timeliness annual financial statements, but not only just having timely on an annual financial statement, having accessible interim financial statements, and maybe taking advantage of some of the things that MSRB have with customized IMA pages so investors can get real-time information. Demonstrating the political will to make tough decisions. The subjective evaluation of credit is going to be substantial, and not just the tough decisions on budget cuts and server delivery suspensions or relief from onerous bargaining agreements, rainy day funds, and all that sort of stuff. But how are you dealing with COVID? Are you making those tough decisions to close down government responsibly? And investors will take a look at that. As for policy changes, I'm gonna leave a lot of this for Ken and Patrick to speak to. The one thing that I am most interested in seeing come to fruition quickly is the reinstatement of advanced refundings for taxes and debt. We have bipartisan support for this, and I never thought this would happen given the scrutiny on scoring from the House and Ways and Means Committee. But it seems like that's a reality, and if that happens, that's going to give a huge feather in the cap to a lot of our issuers looking to extract savings and alternative deal payments.
Kent, you're up next if you want to pick it up there.
Sure. Well, I would say we're pleased with the recovery of the market. We are remaining vigilant, and we don't think we're necessarily out of the woods. I would say that with regard to COVID and the public health challenges that we face, how that translates into muni credits. I think the fiscal issues that are challenging state and local governments and issuers has only just begun. We're at the beginning of a new fiscal year. There's always a lag in terms of revenues, whether they're increases or losses, and this time they're going to be losses. And I think there's a lot of budgets that are being balanced on the hope of federal aid coming. And so I don't think we're out of the woods in terms of muni credit. And again, I hope we don't see something like March, but our market is 70% retail. It's a market that depends very, very heavily on one buyer for the long end. And that's where, as I said before, 80% of the securities are sold to. So we remain vigilant about the municipal market, and our view is the MLF is available at least through the end of the year. And it's designed to be a backstop, but as Patrick helpfully pointed out, our chair has consistently messaged that the MLF is not necessarily constitute all of our powers, and we remain vigilant. And my job and our team's job is to continue to monitor the market. And if additional intervention is required, the Fed's prepared to consider it. In terms of policy, again, our chair has been very clear that, and I think this is a frustration in the muni market, that folks think that monetary policy can solve all these problems, and clearly it cannot. Our job is to make sure that the markets are functioning and people have access to capital, not necessarily at zero interest rates, not to solve the huge lost revenue problem that our state and local governments are and will continue to be facing for some time. So we think monetary policy has to work hand in hand with fiscal policy. And lastly, I just comment about the taxable market. This isn't a Fed position, but a personal Ken Highyield view that I'm a fan of BABS. I thought the taxable securities and the BABS program was tremendously helpful and important 10 years ago. I'd like to see that program, not just because of lower costs, but to better diversify our market. I think one of the positive elements here is we've introduced a lot more of an alternative investor sector to the muni space, and we should seek to try to keep that sector engaged. The new issuance, we should not shouldn't conclude that the market is strong because we've had this record issuance. I think there's been a 250% increase in taxables and a 5% decline in tax exempts year to date. I would also expect there to be very little new money issuance, I should say, going forward because of the impact on muni credits. The first thing that is going to suffer is going to be reductions in rollbacks in capital programs. Most of the supply records we're seeing are because of advanced refundings being done in the taxable market and currents in the tax exempt. So far we've seen reductions in new money unless there were capital programs that were underway and had to be completed, a huge increase in taxables in large part in response to the advanced refunding restrictions, also for universities to basically arbitrage their endowments. So I think taxables are an important element, but I'd like to see taxables for new money as much as they are for advanced refunding.
Thank you. And Patrick, what are you advising your clients at Citi to be mindful of moving forward?
I mean, I think to the first part of your question on credit issues, I mean, I think the technicals have undeniably become much better in the muni market. The market's wide open, as Sarah was saying. I think the fundamental picture still hasn't come into sharp focus. I mean, in some ways, we don't even know what the direct aid to state and local governments is going to be for a few more weeks. And even then state and local governments are going to have to figure out how they're going to balance the checkbook, figure out what kind of cuts are going to be made, what kind of taxes might be raised, what kind of deficit borrowings might happen. I think you saw the headline out of New Jersey. They at least approved the flexibility to borrow $10 billion for deficit financing. So I think issuers are going to be wrestling with that. And of course, that's going to have implications for credit going forward. And I think that is going to come into sharper focus as we move forward. In terms of issuance volumes, I mean, I think clearly, I think there's risk to the upside because of that first point, where I think you could see really significant deficit borrowing. But it depends, as I said, how do issuers decide to balance that equation? And incidentally, the Fed doesn't want them to balance it by completely cutting expenses, and that's part of the reason why there's a very strong argument. And even Chair Powell was making the argument pretty strongly, even though he doesn't want to get involved in political issues. But I think he was making the argument that state and local government aid is important because you don't want, and I think one of the reasons why the 08-09 recession extended as long as it did was because of the layoffs of state and local government. So I think that's a big question mark for the market, which we'll find out in the next few weeks, probably before the August recess. In terms of negotiated competitive, I think we've already seen things swing more towards negotiated for the reasons that we discussed. Although this week we've seen the largest competitive week that we've seen. It's the largest week period that we've seen in supply. There's around 13 billion, biggest week we've had since COVID hit. 3 billion of that is competitive. So that's going to be a big test for the competitive market. That 3 billion is almost half of the total amount that dealers are holding in their books, according to the Fed numbers right now. So that's a large amount of competitive supply coming relative to the liquidity in the market. In terms of the Fed rules, I think that, I think there's going to be two bites at the apple here. There's going to be this phase 4 COVID relief bill, which actually could see, I mean, that state and local government aid is the big headline there, but there could be muni bond provisions that make their way in there, whether it's advanced refundings or a taxable bond option or private activity bond expansion. There's a chance of that. And then there's, in September, again, there's potentially a highway bill extension, which could become a larger infrastructure bill. And that kind of recovery or stimulus type bill could also see some muni bond provisions added in. In terms of the taxable market, even without a taxable bond option being added back in, we've seen the highest issuance we've seen since 2010, the only full year of the BABS program. So yeah, that's certainly been good in terms of bringing in new investors. But it's also benefited those issuers who aren't even tapping the taxable market, because it is pulling supply out of the tax exempt market. The same way that we saw a massive rally in tax exempt, a lowering of tax exempt yields in 2010 because it was pulling so much supply out. We're seeing that same kind of effect happen now, where, as Kent mentioned, there's already a little bit less tax exempt supply. I think we're forecasting tax exempt supply is going to be down 20% by the end of the year. And remember, all that money that's flowing into the mutual funds, that's flowing into tax exempt municipal mutual funds. So it's chasing fewer bonds. So that's all a positive in terms of the technicals for the market going forward.
Great, thank you. And Sarah, you have the last word on this question.
I'll be quick, but I just would reiterate what Gary said in terms of disclosure and reminding people to think of the disclosure as it relates to the ESG, the environmental social governance, and how you are addressing those in your disclosure. It's important to provide what the financial impact of COVID is, but also how are you dealing with it? How are you applying your CARES money? How are you dealing with inequality in your area? And areas of poverty as it relates to COVID and the impact of a recession. And so I think giving that information to your investors will help get them more comfortable to hear with what you're doing. So we try to reiterate that with our issuer clients and expanding their disclosure into that space.
Great, thank you. We have just a couple of minutes before we go into our break. I'm going to throw out one final question for anybody that cares to answer it. We've been talking mostly, obviously, about state and local finance here. I'm curious if you have any thoughts on issuance and issuers and challenges they may face in higher ed, healthcare, and special purpose bonds, and with a twist to that, also potentially what you're seeing in the high yield muni market. So not strictly governmental, but other markets that are more broadly kind of public finance. What might we expect in those markets? So who wants to take a crack at that? Patrick?
Briefly, I would just say in terms of the high yield market, I mean, we've seen even, I think we wouldn't have thought a few months ago that an airline and airport bonds would be able to come readily and be very well received by investors. So we have seen that. There's good TSA data and things that investors can look at. And I think, yeah, people feel like those are pretty essential entities. But I think, yeah, for all the entities that you mentioned, convention centers, hotels, it's kind of turned credit analysts into armchair epidemiologists. And the big question is kind of when do we get a vaccine or when do we get a very effective treatment? And everyone's kind of trying to figure that out and what that means for the revenues of these entities, because frankly, we're not really going to be past this until we have that.
Other thoughts on that, Ken?
Aren't technicals, Patrick, so important, even more so in the high yield? I mean, people think about high yield and I don't think they appreciate how small of a market that is in munis. In corporates, high yield is unrated. In munis, high yield is BBB. Do we really just have a lot of money now chasing the same number of supply that we had 3 months ago?
There is, and I think you could make arguments. I mean, the simple arguments are sort of looking at some of the airline terminal bonds that have priced recently relative to their corporate peers. But I think if you dig like one level deeper, you see that you have gate security and you have some security that doesn't necessarily exist on the corporate side. So yeah, I agree. The technical picture is definitely helping. But I think the municipal high yield analysts are probably a little more sophisticated than they get credit for. So the technical picture is good. But yeah, leave it at that.
Any other thoughts on that? I'm personally, I'm just a little bit curious. I know there's been some higher ed issuance, but any thoughts on the higher ed issuance market? You know, I think it's a big unknown how colleges are going to open, and I think they're all hoping to open and have reduced impact on revenues here in the fall. But any thoughts on how that plays out and how that impacts higher ed issuance?
I can quickly weigh in. I mean, I would say that most of the large schools have all come to market in the last 2 months. A lot starting to come on using the corporate side as opposed to the muni side, but seem to have all been fairly well received by the market. And again, it's disclosure and letting people know what you're doing and putting your plans out there. But I think there's still a lot of unknowns about how they're going to open up in the fall, and they're all starting to release their plans over time. But again, it seems as though the reception on the transactions have been going well.
I still think it's untested though, because we've only seen sort of the well-endowed universities who have a tremendous amount of resources to weather the storm. We haven't seen down-tiered sort of higher ed entities and what the play will be there. And the landscape for what's to come is so unknown that I think really having credibility in the forecast at this particular point would be very, very minimal. So as Kent mentioned before, the taxable sort of buoy we've seen in the higher ed market thus far has largely been driven on an arbitrage play with endowments, right? Now, there's flexibility that you have in issuing taxable debt that maybe that flexibility is now here to stay. Folks now realize they do have it, especially if technicals sort of remain the way they are. But I still think there's a huge unknown with the broader higher ed market to come.
Yeah. And to your point, I know you mentioned earlier the insurance, and like this week Drexel is coming, and they've decided to use insurance. So there's we're seeing a different school that and how they're going about coming to market. So.
All right, I'm gonna let that be the last word. Thank you again, panelists, and thanks to all that are listening on YouTube and Zoom and whatnot. A quick
Rich, you muted yourself. Rich, you're muted.
Oh, the host muted me. I guess that means I'm talking too long. In any event, we are headed to a break. We'll break till 3:45, and then we have individual breakout sessions. And for those that registered for the conference, you would have gotten an email that would direct you to the appropriate Zoom links to log into those breakouts. So again, thanks everybody for listening and participating. Thanks again, panelists, and enjoy the rest of the conference.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.